Hi there, and welcome to my YouTube channel. Today, I'll be bringing to you the topic things you should and should not use your business loan for. In our last topic, we discussed on the various type of business loans offered by microfinance. And today, we'll be diving straight into the things you should and should not divert your business funds into. When starting a business, it seems like there are a million and one things to think about. A business loan is a great source of capital, but it is difficult to navigate the countless number of loan options available to small business owners. Small business loans, conventional bank loans, online capital loans, and person-to-person loans are just a few types of loans that small businesses are eligible for. There are certain factors you need to take into consideration in order to make sure you're getting the right kind of loan and you aren't overpaying. When searching for a business loan, take these five key points into consideration. The first point is limit the number of loans you apply for. When going in for a business loan, it can be tempting to apply for as many loans as possible in the hopes that something will stick. However, such an approach can hurt your credit score, making it harder to qualify for a loan. Every time you apply for a business loan, the lender will check your credit. In some cases, such as when getting an initial quote, the lender will do a soft credit pull, which won't affect your credit score. However, when you submit a full application, the lender will do a hard credit pull. This can dent your credit score by a few points for each application. Sometimes, even getting an initial quote can trigger a hard credit pull. The best approach is to first find out different lenders' qualification criteria, apply strategically for the two or three options that you are most likely to qualify for. Also, be sure to ask the lender about its credit check policies so you are not caught by surprise. The second point is to understand the cost of the loan. Lenders describe the cost of a loan in different ways. Some will tell you the interest rate on the loan, and others may tell you the total amount of money you have to pay back. When lenders describe loan costs in different ways, it makes it difficult to compare your loan options. To make comparison shopping easier, ask the lender to tell you the annual percentage rate of the loan. An annual percentage rate is the total cost of a loan over 1 year, including its fees. The annual percentage rate of a bank ranges from 6 to 9%. It can be much higher for alternative lenders that provide fast funding and work with lower credit borrowers. Keep in mind that a low annual percentage rate isn't necessarily better than a high annual percentage rate. But since they are paid off quickly, you are not paying interest for a long time. As a result, the total amount of money that you have to pay back is relatively low. The third point is to be cautious of prepayment penalties. While on the topic of cost, prepayment penalties can be a trap for an uncautious borrower. A prepayment penalty is a fee that the lender charges if you pay off a loan before the due date. By paying a loan off early, you reduce the amount of interest that a lender earns on the loan. So they charge a penalty. The fee is usually 2 to 3% of the outstanding balance of the loan, or it can be on a sliding scale where the earlier you pay, the higher penalty will be. Not all loans have a prepayment penalty. For example, standard small business administration loans don't have prepayment penalties. When shopping for a loan, you may also be able to negotiate the removal or reduction of prepayment penalty. That will greatly help you in your loan repayment. The fourth point is to choose between a line of credit and a traditional loan. Depending on your business needs, a business line of credit may be a better option than a loan. A loan is a fixed amount of money that you pay back with interest over a specific period of time. Why? A line of credit is like a credit card. You get approved for a maximum amount of money that you can access as needed, and you repay it over a period of time. The advantage of a line of credit is that you only have to pay interest on the funds you've used. The fifth point is to understand which assets are at stake if you can't pay back the loan. Most lenders will not give a loan to a business, especially a startup, unless it's secured by collateral, line, or a personal guarantee. This should not be taken lightly. Valuable personal and business assets may be at stake if you don't pay back the loan, and you should understand what's on the line. Loans may be backed by specific collateral, for example, property, equipment, inventory, and so on, or by general line on your business asset. When a loan is backed by specific collateral, you give the lender the right size that collateral if you can't pay back the loan. If a loan is backed by a general line, then the lender can take any or all business asset to satisfy an unpaid loan. Even a loan with no collateral or lines may require a personal guarantee. This allows the lender to seize your personal assets such as your home and car if you are unable to pay back the loan. There are a lot of things to consider when you are trying to obtain a business loan, and it can seem overwhelming following the 5 tips above, which will help you assess the basics of the loan and avoid making a big mistake like pledging your house as collateral without an understanding what that means. Every business is different and every business needs financing for different reasons. With that in mind, it's best to ask a trusted advisor and your lender all of your questions before committing to a loan. Thank you for watching, and if you did enjoy this video, please don't forget to like, share, subscribe for other interesting videos.